Welcome back, everybody. I am here with a very special guest who we actually just recently met.
Yeah.
And crazy how many synergies there are, but we come from two totally different backgrounds.
I know, right?
And kind of converging into the same space. So I'm here with Matt, and so we're very, very blessed that you're able to join with us today. So,
yeah, cool.
Matt, for everyone who's kind of listening, doesn't have a background, give us a little background story about who you are, what you've done, and where you're at.
Sure. So, Matt Faircloth, I've been full-time real estate investing for the last 20 years. I've done multifamily deals and probably about 4 dozen fix and flips. I did a lot of it with other people's money, which inspired me to write the book for Bigger Pockets, because we're sitting here at the Bigger Pockets conference, so you got to mention it, give them a little shout out, right? I wrote a book for Bigger Pockets called Raising Private Capital, which is how to go into your own network and look into your phone and find millions of dollars. I just submit to all you guys, there's probably at least 3 million in money in your phone. People that you know already that don't realize it yet, but are looking for a better way to invest and make their money, like investing in hotels or multifamily, those kinds of things. So brief intro.
Yeah. And so you started out you were an engineer, I think you said,
by
right?
trade, yeah.
Yeah, so an engineer by trade,
Yeah.
and then you moved into real estate, right?
Yeah, because my wife, who you just met a second ago, I got to give a shout out, of course, to the wives,
To
the wives in our lives, right? She, when we were dating, put Rich Dad, Poor Dad in my hand. And I knew I didn't want to be I was a traveling sales rep. I didn't want to do that forever, but it was good enough money. It's financial, it's the, what do they call it, the golden handcuffs, right?
Yep.
So the money's good enough to keep you doing something you don't like.
Yep.
So you could freaking hate your job, hate your everything, but wow, they pay really well. So it's like the worst is, so I was doing it, but I knew I didn't want the next job above that. I wanted to climb the corporate ladder. It wasn't fulfilling me, but it was paying me. But so she put Rich Dad Poor Dad in my hand, and I said, wait a minute, I could get fulfilled in building a business. This is inspiring. Yeah. And I could give back. We do a lot of give back now. And so owning a business has created that lifestyle for me. And so when her and I got married, I quit my day job immediately. I worked for Ingersoll Rand, and I quit my job at Ingersoll Rand, and I started our company, the DeRosa Group, which, by the way, DeRosa is her mother's maiden name. So that's where DeRosa comes from.
And the DeRosa Group primarily invested in multifamily, right? And
we gravitated to that. So we grew into that. I started out in a single-family home that I lived in with two of my buddies. House hack. Yeah, but that was back before all these things had cool names, right?
Yeah.
Back before house hack was a thing. Back before Burr was a thing. I did all that. It's just called, like running it on refinancing, right? With Brandon Turner, like really blessed our industry with cool, tight, and acronyms.
Names.
But just so you don't know what it is, right? So I did house hack, and then we started doing Burr strategy stuff. And it just evolved slowly with our own money until my wife connected with a guy that she went to grad school with, because I married up and married a smart girl, and so she went to grad school at Penn, and so this guy that she knew from Penn, she was getting reconnected with, and she was like, yeah, I'm doing this consulting work, but my husband's building a real estate company, focused on real estate investments, and he says what I tell folks that I work with. I was like, this is the magic words he says, which is, man, real estate investing, that sounds so great. I wish I could do that too, but I just don't have the time. Right? And she goes, you should talk to my husband. So I jump on a train up to New York City to go meet this guy. And we have coffee, and he's a financial planner in New York, right? So we're having coffee, and he just I tell him what we're up to, our business, and he just goes, what if I give you 50 grand? Right? And at that point, I'm like, right, what if you did? What if you did? Right. So what if I give you 50 grand to do a deal, and you just go find something that makes sense, that's going to make us money, and you do all the work, and I'll give you 50 grand. That's what I have access to. And I was like, okay. So I went out and found a couple of beater townhomes. It was 2010, back when like a lot of, you remember
coming out of the
financial. Well, a lot of the thing then was short sales. That might become a thing again, but that's where a bank sells a property for less than what they were owed on it, right? These two properties, believe it or not, back in the day, the bank was owed 170 grand on these two properties. I bought them for 50,000 bucks.
Get out.
Yeah. It was a weird time, man. Weird time.
Feels like those days are gone, but you never know.
I don't know if it'll get, maybe
not that far, but
that was before Dodd-Frank and before like a lot of regulations.
Right.
When the people that bought those properties could have bought them bringing nothing but a pen to closing.
Yeah.
Like you could do a lot of no money down deals and stuff like that. Now it's just all that came back and bit us
Yeah.
in the butt. Maybe we don't get back to that point, but I think that we'll start to see a little bit more banks just having no tolerance and just, okay, I got to get this debt off our books.
Yeah.
Anyway, so we buy these properties, we fix them up, we put them back on the market and rent them out, and this is great, making $300 a month or whatever it is, passive income each. And he starts telling his clients and his friends about it, and I start telling others about it, that, hey, this is how this is working. And so we went from about 30 units to 300 units in like 2 years.
And this is leveraging other people's
OPM.
Yeah.
Right. Through his clients and through people that I knew.
Yeah.
And through me just putting some posts out on Facebook and stuff like that.
Yeah.
Fast forward to, again, I stumbled into a lot of this. It's just how it goes, isn't it?
Yeah.
You want to think that life's this whole big grand plan, but it's not. You kind of just stumble in, like, oh, you bump into the stuff. Right?
Yeah, but I will say it's like people always say closed mouths don't get fed, right?
Nope.
And it's like you say stumble upon, but I mean that's the whole reason why we're doing this is you need to talk about it, right?
Yeah.
Like people need to know what you're doing. Otherwise, your wife met the financial planner. She's talking about what we're doing. He's talking about I would love to passively invest, and that's how these things happen, right?
Yeah. So another thing blew it up for us. We started, I had a couple of investors at the time, maybe like a dozen, and I started putting updates for the investors on YouTube, right? And I put it up there just so they can watch, see where the money is. Hey, here's the kitchen, here's this, here's that. And just because you never know, open mouths don't get fed, get fed, right? I put it on YouTube public, right? So I did, and I started getting questions from other people that are like, hey, what kind of kitchen, like what kind of paint sheet? I had you do the thing or whatever. And I'm like, oh, I have a following now. I got people.
Yeah.
And it was the investors originally, but then other people start watching this YouTube channel that was originally intended for investor updates. So then I start putting content on YouTube, educating people about real estate. And the phone starts ringing, people being like, hey, you're that YouTube guy. Talking about real estate investing on YouTube. This is back in 2013.
Wow.
When not everybody was doing that. Now everybody and mom's got a YouTube channel.
Yeah.
But I just started doing it when it was earlier into the life of YouTube. Fast forward to the phone starts ringing and stuff like that. Then another big pivot for me in my career was Liz found this fledgling, brand new starting website called biggerpockets.com.
It's amazing.
And they had put a forum post out that they were looking for people to write articles, right? So we do this conference call with one of their employees. The employee is Brandon Turner, right?
Yep.
And we have a call with him and about like, hey, what have you guys done? What's your backstory? What do you guys want to write about? And he's like, okay, cool, you can do it. So we start writing articles for Bigger Pockets, and it goes nowhere for a while. So you just put them out there. But after like 6 months to a year, we start getting
off.
Yeah, and we start getting more and more people like, hey, I heard about you on BP or whatever.
Yeah.
So it's those little like culminations of effort of getting the word out about what you do. And maybe the lesson is you just never know really who's going to listen at one point.
Yeah.
So really the lesson is really Gary Vaynerchuk, make content.
Yeah.
Right?
Yeah.
And at some point, the right person's going to catch the content you make, and it's going to take you to the next level.
Yeah, and you never know when it's going to turn into rocket fuel, right? Like it's the first 6 months. If you quit 6 months in, maybe you would have never seen like what that turns into.
Yeah.
And YouTube, like 2013, like nobody was doing it.
I had no idea.
Yeah.
And I tried a lot of things as well that honestly, I don't even remember what they were.
Yeah.
But I knew I tried different things to get the word out about what I was doing.
Yeah.
And just not everything worked.
Yeah.
I remember what worked. I don't remember what didn't work.
Yeah.
Because it's not even worth focusing on, right?
Right.
But the factor, like there, I'm the big capital guy, and so we started doing bigger and bigger multifamily projects back when multifamily was a bit easier to do, I think. We were doing multifamily because it cash flowed a bit, but mostly it appreciated quickly.
Yeah.
And that's what I love about multifamily is mostly the appreciation side.
Yeah, yeah. And it makes it huge for raising capital, for being attractive to high net worth individuals, high income individuals. So,
well, a lot of people in the market, investors want something they can understand.
Yeah.
Everyone understands multifamily. It's very easy to comprehend. When we were raising capital for recently a hotel purchase that we just did, a lot of our investors, I don't know if you experienced this in your industry, they didn't get it. Yeah. They don't like it's too risky. I don't like hotels, whatever. I'm like, you don't know what you're talking about.
It's because all you multifamily guys talking about the Sharp ratio, and it's like, it's. But so how do you de-risk it?
Right.
How do you de-risk hotels?
hotel?
Yeah, for people who do still think that it's too risky, why do you say it's not?
I think you partner with a brand,
Yeah.
because I think that a billion-dollar company like Hilton knows what they're doing. We'll
Yeah.
say, right? Like
Yeah.
I'm sure they make plenty of mistakes, but they know the color sheets I'm supposed to use. They did a psychological analysis on which
color
paint works and what has better human affinities and
Yeah.
things like that. So I don't need to be like, I like purple. So I'm going to paint that wall purple
Yeah.
because I think it's cool.
Yeah.
Because I got some extra purple paint or because I want to be creative flair or whatever.
Yeah.
No, Hilton doesn't let you do any of that stuff. And that's okay. If you want to be creative, tough to do. You want to use something that has been proven to work. That's how you de-risk a bit of it, I think.
Yeah.
Is by working with Hilton.
Yeah.
Or working with a branded entity. And that's my philosophy.
I mean, the best, something I talk about all the time, but the best example is I'm in Ohio, right? So when you're going to Ohio and you want to stay at a hotel, you're not going to stay at the Matt Inn on a random street, right? You're gonna go to Marriott.com or you're gonna go to Hilton.com, and the proof is there. You know exactly what to expect. There's a certain standard that's there as well.
And you know how many Hilton loyalty members
insane.
there are, right?
Yeah.
It's the number that I saw is 300 million.
Yeah.
Right? So if I stay at the Matt Inn, it could be in the best location ever, in downtown whatever, and right next door to all the fun stuff that you need. But I don't get any cool points.
And you don't get your 10th night free.
Right. I don't get any nothing.
Yeah.
I don't get a punch card stamped or anything like that. I get nothing if I stay at the Matt Inn. But if I stay at Hilton, I could have a Hilton credit card.
Status.
Yeah, I get status. I could get the nicer rooms. I get to check in early. I could do a couple of business trips on Hilton and then take my family away to a Hilton all-inclusive.
Yep.
You want to go fancy pants, I could do all that too.
Yeah.
So I for all the aspects of it, I feel like Hilton de-risks a good bit. On top of that, assets that have business plans where you're not going to just step in and just keep driving, right?
Yeah.
The one that we're buying, the Home 2 Suites, they're under on rent.
Yeah.
The RevPAR is well below what the market is because they wanted to stay higher occupied. This is crazy. Again, this guy to him is just like, whatever. But to me, what I learned is you want to see a hotel at 70, maybe 75% occupancy, which is a multifamily guy. I'm like, what?
That's terrible.
90%.
Yeah.
Right? This hotel that we're buying is at 85% occupancy, which to you means they're not charging enough.
Increase the rate, lower the lower the occupancy.
To me, I hear 85, you're almost there.
Yeah.
It'll be 90, right? Yeah.
Right. No, that's awesome, man. Yeah. And so tell me about why the transition, even from, I'm sure you'll still do some multifamily deals if you find good ones and stuff, but why shifting the focus a little bit to hospitality and hotel
Let's
investing?
do quick crash course on cap rates, okay? So the cap rate, which is, some would say, which I agree that this is the good way to look at it, that a cap rate is really the market's testament to the risk factor of that asset, right?
Yeah.
The higher the cap rate is, the higher the risk that the market, that is the perceived risk, not real risk, perceived risk for that asset, right? So a multifamily property is perceived to be less risky overall, and so the cap rates are lower. And there's good reason why it's deemed to be not that risky. The government provides a lot of different incentives for loan programs and also for rent payment programs. There's a lot of backstops, and it is a foundation of society. We need to have roofs over people's heads. It's a core human need, right? So yes, it is important to have, that multifamily is there and it's got a low risk factor for that, which is why back in the day, multifamily was trading at a 4 cap, 5% cap rate, now maybe a 6 cap, right? What that does for you, okay, is a low cap rate like that, is it enables you to, if I go and make a change in my multifamily and I push rents $100, it could be I put new cabinets, new fancy bathrooms and everything like that. I push rents $100 a month, that's $1,200 a year. And let's say I'm running a 100-unit multifamily property, right?
Yep.
That's 1,200 times 100, okay? Right, times 100 units. That's 120,000 a year, right?
Yep.
That I'm making in additional bottom line revenue. I divide that number by 0.6. Not so fast on the math, but I think I've increased that property value by probably $800,000-900,000, right? That's pretty good off of just doing a little bit of reno, maybe investing maybe $100,000, $200,000 in value to the property, right? So that's what's great about multifamily is it appreciates quickly because of the low cap rate. Let's put that over here. Then you got hotels, right? Hotels are perceived to be a
More
higher
risk.
risk. And so they trade at a much higher cap rate. 8, 9, you probably seen a hotel at 10%.
Yep.
Hope you bought it. But 8 to 9 is common to see. What's interesting on that is you can borrow money for less than that, right? So although I can go and take a hotel and push revenue and push bottom line, it's not going to go and double in value. I'm selling a multifamily property right now that I bought for $3.3 million. I'm selling it for $7.4.
Yeah.
And mostly what I did, increase revenue because of the cap rates and that kind of thing.
Right.
A hotel might trade for a little bit more because it doesn't go up as fast because the cap rate's low. But what a hotel will do for you
Cash flow.
is cash flow,
Yep.
right?
Nailed it.
And cash flow, especially in today's economy, right? Cash flow is king, man.
Yeah.
Because it's money now.
Yeah.
I think in a market where we're not 100% sure what the future is going to bring, let's just own it, right?
Yeah.
There's a little bit of market uncertainty. I'd rather have profit in my pocket today than betting on the coming, okay? So that's why I like hotels, especially branded hotels. And I think that they're a good combination of a multifamily asset that has a good shot, if I run a good business, of doubling in value in 5-10 years, and a hotel of paying me today.
Yeah.
A hotel is going to yield you 15, 18, maybe 20% cash on cash return, maybe more for some of your deals you told me, right? Which is awesome because you're a good operator. So, but like 80% of that profit came during the hold cycle.
Yeah.
It didn't come when I sold it.
Yep.
It came while I was holding the asset, right?
Yeah.
So that's what I love about hotels in like conjunction with multifamily. We might, as my company, do a hotel multifamily fund. How cool would that be?
Yeah.
It pays out good returns now, and it grows later.
Yeah.
What a
You
good
get the
combination.
appreciation plus you get the cash flow. And that's what I love about hotels today is like it's business plus real estate. And the business component of it really drives that cash flow and cash flowing from day one.
Yeah.
You could just do minor tweaks to the operation, minor tweaks to the value add, minor tweaks to the ADR, the revenue management, and now all of a sudden it goes from a 4 or 5% cash flowing property to an 8-9% a year. It's insane. Yeah.
I got to tell you, so there's such a misconception on hotels too. So when I was presenting this to investors, they were like, "Well, do we have to own the business too? Can we just buy the sticks and bricks? Can we just buy the dirt, and then we'll rent it out?" They were like, "So we're going to buy the building." And we're going to rent it out to Hilton.
Yeah.
Like they're going to do that, right? Like that's what they thought was going to happen.
Yeah.
Is that I'm going to buy this and Hilton's going to show up as my tenant. I'm like, you wish that's what's going to happen. And I guarantee it's not going to be an 8 cap if that's the way that it went down, right?
Yeah.
No, we got to own the whole thing.
Yeah.
And we're going to buy a franchise from Hilton because hotels are franchises.
Yeah.
Hilton does not own those properties.
Yeah.
No. Folks like you and me do.
Yeah.
Right?
No, Matt, I love it. I know, Matt's crushing it. He has a book signing later. He's speaking. And so
he writes a book on hotels. Then he'll be beside me at the book signing. We're bringing it up until he does it. Okay, you guys? All right.
I love you, Matt. But I know you're on a little bit of a time crunch and stuff. But one of the things about your story that I absolutely love is that you were ahead of it. You took risks. You went out, started doing things on YouTube. You started writing articles when no one else was doing it. No one was utilizing social media. Now, in my opinion, you're getting into an asset class that is, it's completely overlooked. And you're lucky enough to be ahead of the curve, right? And you continue to do that. And so one question that I did want to ask you is,
Tell me.
How do you get yourself to kind of take that risk and do some and travel the path that's less traveled, right?
Yeah.
And so if you could leave us with an answer to that question, and a little bit about throughout your journey, why you did that and what motivated you to continue doing that.
Wow, it's my father-in-law gave me an adage a long time ago. If you observe the masses and do the opposite, that's a lot of times that's where success is. And those, as I've researched success and heard a lot of people's success stories from stages like here at Bigger Pockets or whatever, the story is typically for people that wanted to try things different. And they took some calculated risks, and they got lucky. Something broke the right way for them.
Yeah.
Right. And sure, they took 5 risks. 4 of them didn't work out. But that one that did is where it took off, right? Yeah. That's why I believe that it's okay to take calculated risk. I've got my teeth kicked in a few times. Entrepreneurship is not for the faint of heart, man. You and I could compare battle scars on another episode, right? But I find that road less traveled of walking into calculated risk is where a lot of the rewards are. And it sure makes a hell of a story too.
Yeah, no, I love it, man. I love it.
Can I go over time with you and ask a question?
Yeah.
Do you think that there is a world one day where hotels, specifically branded hotels, become more accepted as more stable investments, right? If people looked at the way hotels perform, especially limited service assets like Home 2 Suites, Hampton Inn,
Right.
Do you think that there's a world where the market starts to view those as higher affinity, low risk? And do you think there's a place where cap rates start to come down on hotels? Because that helps you and I both.
Yeah, who are already in it, right?
Right.
Yeah.
Yeah,
so,
who's already in.
Yeah. So two parts. I think one of the issues with these branded hotels is a small group of people have owned them historically and haven't allowed people to kind of come into the industry, right? And one benefit of having these brands is you do, in a sense, have a right of refusal, right? So if I own a few Hiltons in that market, I'll be in touch with my Hilton rep, and if anybody's coming into that market, I'll try to block them out from a construction and a new build perspective, right? So, but now with social media and the world that we live in, I think that's becoming less and less true, and I think more people are getting into the market, like yourself, right? And I think that in itself will push a lot of competition. The second thing is I think people view hotels as a risky asset class because they don't know what they don't know, right? And when they look at a P&L and they see 50 line items, I see that as opportunity to now, hey, if we can 5% here and 5% here, now all of a sudden we flow so much down to the bottom line, right? And a lot of my value add is just a little bit of operations, right? Take a little bit of meat off the pig, right? And now all of a sudden we're cash flowing like crazy, right? And so as more education is available on operations, on how to do the thing, I think now all of a sudden it's going to open up the floodgates, and I'm already seeing it. I don't know if you are, but I mean, we have a hotel program, a coaching academy where, like people are booking calls left and right, asking about how they can get into it, right? And so when there's competition, cap rates are going to shrink. But I think because of the business component, the cash flow is always going to be strong, which is going to push the cap rates higher.
I hope so.
So,
it's happened to other asset classes, right? Like I was never in this world, but friends told me that when they first started getting into mobile home parks, you go to mobile home park conference, and it's a bunch of dudes in Hawaiian shirts that are like heart retired. They're just kind of there to hang out. It's like a Jimmy Buffett concert, right? Then, like somehow or another, corporate found out about it, and now the mobile home park conferences is all suits, right? It's the cap rates in mobile home parks that used to be viewed to be very risky, are now much, much lower because it's gotten correlated with multifamily. Like, okay, it's housing. Not good. Hotels are not housing.
Right.
Mobile home parks are. And so that's perhaps the reason for the shift. But asset classes and the market's perception thereof do change over time.
Yeah, no, I agree, and I do see private equity and larger corporations getting into the thing, right? And
that's
so
what our business plan for the Home 2 Suites that we're buying is like, hey, let's do like 7, maybe 10 of them and roll them up, right? Roll them up to private equity. So that does happen. They're not going to buy one, but they'll buy a portfolio of them that are performing well.
No, I love it, man. Thank you so much, Matt. I appreciate your time. We'll definitely have to do more of these, right? And looking forward to doing a deal with you as well. So
I like that.
Yeah,
cool. Thanks for watching, guys.
Thank you.
DeRosaGroup.com is my company website. You want to hear more about me? DEROSA. DeRosaGroup.com is the website to hear more about my company and what we're up to. Thanks.
Yeah, and if you're looking to passively invest, I mean, great opportunity here. And when we put this out, we'll have all your contact info in there and stuff as well. So awesome. Thank you so much.
Thanks, Jeremy.
That's fun. Good. Yeah.